The Financial Survival Network, helping you survive and thrive in the new economy. Go to KerryLutz.com and sign up for 30 free micro trainings on financial survival.
1490 WGCH. This is Kerry Lutz, and you're listening to the Financial Survival Network, which is brought to you by Miles Franklin. They've been in business selling gold and silver for over 20 years, and I'm a customer because when you buy, they ship. For more information, find them on the web at milesfranklin.com or give them a call at 800-822-8080 and get a free quote.
Hello, everybody. Welcome to another edition of the Value Guys Stock Talk Show with the Value Guys. I'm Val Hughes.
And I'm Momentum.
And we are 31.32-year Wall Street veterans who have had to take on secret identities and go underground in order to provide you with our candid views on a handful of stocks that we screen for each week here in the shop. You've seen our faces on TV. You've seen us quoted in the news, but our bosses would never allow our unfiltered views on the air, so we've disguised our voices, and they'll never know. This week is the June 12th, 2012 edition of the Value Guys Stock Talk Show, and we've done a screen, an equity screen this week to provide three terrific value ideas based on return on assets, return on equity, and asset turnover, a little bit of an obscure screen that we'll talk about. We'll get to that in a minute. But first, a couple of important caveats. First, this show is for entertainment purposes only. That's not a guarantee. Secondly, this is a hobby for Mo and I after hours. We're professional analysts during the week doing a lot of careful fundamental analysis, including financial projections, conference calls with management, examination of competitors. We're doing absolutely none of that here. Third, our lawyers remind us to tell you that we may not have your best interests in mind and may recommend the opposite of what actually is in your own best interest, so do your own work. And fourth, and this may become increasingly evident during the course of the show, but I've been heavily drinking, and Mo this week's been joining in, so who knows what might happen this week on the show. See all our caveats. Pictures our moms took, lists of best ideas, and other stuff I can't really remember at the moment that's out there. www.thevalueguys.com. Okay, so for new listeners, here's what we do on the Value Guys Stock Talk Show. We provide 3 or 4 really terrific value ideas that we usually use here in the shop, or at least they're on our to-do list here in the shop. And we're running different screens that we use in the shop. This week, and I was really tight for time, Mo. I don't know about you. You had a busy
We did.
week. But I just, we have buttons right on FactSet that make screens, so I don't really have to do much. The one this week was to look for those stocks that met the following screen. Below $3 billion in market cap, so small cap land. Above average, I believe it's sales to assets, so above average asset turnover relative to their industry, above average return on assets relative to their industry, both good grandmother, metrics, and then finally in the top 20% of your industry in return on equity. So those were the 3 metrics. We got about 40 names that came out of that, and we just picked 3. I don't want to say randomly because we did look through them, but we were a little tight for time. But I do think we have at least one really terrific idea and 2 kind of semi-interesting ones. I don't know.
Well, that since we've given each one of these names about 3 minutes of
3
analysis.
to 4 minutes.
But when you measure analyst years, which is like dog years times, they've said dog years times 72, those 3 minutes of analysis?
It's like an hour or something. Right?
Oh, no.
2 hours, no.
For an ordinary person?
Yeah.
The professionals say a year and a half.
A year and a half.
Yeah, an ordinary person would do a year and a half to figure out what we think.
Half.
Yeah.
Yeah.
So
well, just transcribing
And
from the Chinese would take some.
I'm just saying that's what the science is.
No, I mean we're not advocating that. It's
Right,
just
I'm just saying that's what you can't.
Okay. Well, we're going to get to all that in a minute. Let me give you the names. We're going to do something called Kingold Jewelry, ticker KGJI, and I've never heard of this in my life. The market cap is 135 million, so that's pretty small. Owens Minor, OMI, which is a real company, and it's a medical products distributor. And then finally, U.S. Home Systems, USHS. But before we get to that, an important segment here on the show, Value Guys, Wall Street News, right?
Yeah.
But that's your area. So I don't know if you even did anything.
Well, we have a couple of things. We just want to let you know that if you go onto the website, Warren Buffett's lunch just sold for $3,456,789,000.
Did you bid on that, Mo?
For lunch? Yeah, I was in the very early bidders.
When
it first went on, just so I could say I was in the front.
Yeah, I was a bidder.
I was up at $8.
I bid $35.
Did you? You went.
Well, I mean, you can always just watch them on YouTube.
But you know what? You're either a player or you're not. Doesn't matter whether you're winning, and so we were.
Only one guy
So
wins.
go on the website, bid on lunch with Mo and myself. Starting
you
bids.
are Mo though.
Starting bids are. Oh yeah.
Val. Right. Val.
And starting bids are at 87 cents.
87 cents because of the crash.
Well,
yeah, you got to start it from somewhere.
You got to start somewhere.
Okay, yeah, no, we're definitely up for that.
So,
and winner picks the place, right?
Winner picks the place. So just go on our website and look for that, and you can. And you know what? We're a bargain compared to Warren Buffett because we have funds that can totally mirror his. We know exactly what his investment strategy is.
What's public documents?
We've even copied his asset allocation model. So think about it. Us for 87 cents. Warren Buffett 3.5 million.
Right. Exactly.
Listeners, you choose.
Yeah, it's up to you, listeners.
There you go. Other news.
Yeah, I have no news this week, Mo. I didn't do anything.
You know what?
In that department.
Listen to this.
You have some. What do you got?
Congressional Budget Office just releases the financial status on our congressman.
Uh-oh.
Who's worth what?
Who's worth what? I didn't see that.
These are guys that have been able to trade on insider information for the last 20 years, and only half of them are millionaires. Losers.
Wow.
Losers.
Well, that tells you something about the intellect over there. They've got inside information, and they can't beat the market. Unbelievable.
Not a good thing.
Okay. I had a little news today. I don't know why I picked this out. I was just like, hey, we like to give people the news. There's a site called Real-Time Economics, and I don't know if it's real-time or not, but
it's dated yesterday.
Yeah, it's dated, or actually it's dated a few days ago. Here's the thing. We've been talking here on the Value Guys and other venues, much less prestigious than us, have been talking about this. There's a ton of cash on corporate balance sheets. A ton. And the reason I know that is because I look at corporate balance sheets and they have a ton of cash. So I'm kind of bottom up in that regard. But at the same time, the government's out saying there's more cash than ever before. I mean, it makes some sense. A few years ago, the banks completely froze up and said, we're not loaning you any money. I hope you can afford for your payroll and inventory. So since that time, just for preservation purposes, companies have been keeping a little higher cash balance just so they don't go broke. And you might say, why don't they want to go broke? Well, if you really have to ask that question, you're not a capitalist. So I just say they don't go broke because that's death to a company. So they got to keep a little more cash, and everybody's been reporting it. It's been, those bad corporations are hoarding cash and not just paying people to sit in chairs and do nothing. But the Federal Reserve, I mean, think of all the data that we look to the Federal Reserve to provide. In fact, even here on the show, I'm constantly saying, go to the Federal, Bank of St. Louis, get all your data there, etc. It's great data. Well, on last Thursday, the Federal Reserve sharply reduced their estimate of total corporate cash. So maybe these corporations aren't as evil and bad as everybody says.
Maybe they're not as safe as people thought.
No, well, they also may not be as safe, but evidently, instead of let's see here, instead of $1.74 trillion in liquid assets, the Federal Reserve now says, you know what? We overestimated that by $500 billion. That's 30-something 5% more than the actual number. But, hey, the good news is we still have $1 trillion on hand. So that's still good. But the article points out that's the same relative amount that they had 20 years ago. And suddenly it doesn't seem like there's so much corporate cash hoarding going on. But I thought that was unbelievable. It's, we miscounted a third of the cash.
Let me ask you a question. We were talking about this earlier tonight. We both started off the same job, same firm. Yeah. You interviewed me. So what do you think would happen to you anywhere along the trajectory of your career if you were off 30%?
On my
anything.
Estimates? Well, you're fired. Estimate? I mean, you're fired.
Right. So do those guys get fired?
I don't know. I think Bernanke is appointed for what? 2-year period? I'm not sure.
How do we get those jobs? That would be a great job.
Well, you got to be a professor
or a weatherman.
Yeah. Well, that's how Letterman made it into the pundit category.
How else can you be off that much?
I don't know.
So often
it's unbelievable.
And keep your job, but I think 30% off.
Yeah, that's what I'm mentioning. I mean, it's unbelievable.
Boom.
The Federal Reserve.
Yeah.
Wow.
Great job if you can get it.
Okay, let's get into the stocks. We're 11 minutes into the show.
Uh-oh.
And I'm starting to get a little sleepy, so I just want to get into it here, okay? First up, we're going to go alphabetical. H-I-J-K. Okay, I got it. Here we go. Well, this one's yours. Mo, you found this one.
Well, I liked it because it's Kingold Jewelry. The ticker symbol is KGJI. It's a $2.50 stock, but it's a jewelry designer that manufactures and markets gold in the People's Republic of China. So if you believe the whole big macro trend, China becoming the new U.S. globally, a huge rising middle class, anxious for all of the signifiers of wealth.
Yeah, they want a Western lifestyle.
They want gold. They want some Louis Vuitton. The luxury brands that's gonna be a big long-term trend out there. And so I'm thinking, it's gold, so you got an option to the extent that the euro breaks, you have pandemonium, people continue to flood to safe stocks.
Nothing would be better.
The gold stocks go up, and the gold jewelers that are trafficking that go up.
You gotta love a little pandemonium now and then for the gold guys, right?
It's pandemonium's an important part of the equity risk decision.
Part of the strategy,
right?
Absolutely.
So it's a play on pandemonium.
Which is not in short supply these days.
Not
right?
in short supply.
It's also the year of the dragon. I'm not a big gold guy, but I think the year of the dragon, people love gold in the year of the dragon, right?
Yep. So it's a euro play.
Yeah.
It's a play on macro trends of developing of a middle class in China, and
go for it, Chinese.
Yep. So purely from a conceptual standpoint, and how can you not love a $2.50 stock?
Well, I mean,
you could buy it so little to lose.
Well, it's so little.
It's not like buying $100 stock.
It could be so little to gain too.
Well,
I mean, so what about the valuation, Mo? We aren't hearing a lot about that.
That's what you're here for.
Oh, that's what I'm here.
You're Val, remember?
Oh yeah, okay. Well, I will say the enterprise value to EBITDA, which I like to think about as a cash yield of, in this case, it would be around 30%. I don't want to do all the math. It's been as high as 31, so it's 1/10 of that now, and as low as 1.2. So it's kind of in the middle of its range on enterprise value to EBITDA. I can't help but notice, at least in the recent weeks, commodity prices are heading down, but that's just in dollars. And but because the euro's weakening, I mean, it's going down even more in euros. I don't know what it's doing in China, except that I think the Chinese, what do they have over there? the yuan or something. I don't know.
Yes.
They are kind of tied to the dollar. You know, they give up a few percent every year to the people screaming for letting your currency float, but they're not actually letting it float. They're letting it rise by a few percent per year. So they're basically tied to the dollar, and commodity prices in dollars have been going down. But on the other hand, this thing's gone from 10 to 3 in the last year, so some of that's clearly in the stock. The sales have been going up while the price has been going down, so undoubtedly the value of gold is being included into the market's perception of the value here. EBITDA margins, remarkably stable for such a volatile commodity. They must just be, you know, who knows? I mean, sales are just going up. The commodity is volatile, so you'd have to work that out. Maybe that's just some sort of fee. Return on assets, we've only got a few years here. Data seems kind of incomplete in the years when, you know, the value was low, but they're putting up mid-teens on assets right now, close to 20% on equity. So in terms of those kind of metrics, it actually does look like a good deal. But as a value guy, I'd say, what's the underlying commodity doing? Because it isn't a commodity. It's not like they have any edge. They do gold, which other gold makers do. So it's a matter of, are their costs lower than other people to produce? Are their costs lower to distribute? And I'd want to get a little bit more into that. But if you look at their historical valuation ranges, it does look on the low end. But I have no idea what commodity prices are going to do, Mo. That's my problem with these kinds of things.
Well, you know, you said that yeah, sales are growing, and I agree. But let's quantify that. You know, this company didn't produce any sales until 2009, and they've gone from 250,000.
Is that 1,000?
Or not million? Is it a million?
They don't tell me here.
It's 250.
250
to 500 to almost 800.
It's got to be a million.
Yeah. So 250, 500, 800 million. That's quite a jump. So I think that some of the fundamentals are you know, looking pretty interesting. There's a zero debt, but let me ask you a question.
I do like that.
Yeah. So here's what we did this last week, and it's a little bit of an inside thing. You get to see how we work.
You're going to give away some secret methodology here, Mo.
It's guess the dividend.
Didn't you sign an NDA on the way in here? What?
It's guess the dividend time.
Okay, guess the dividend.
I'm going to read you a series of annual dividends, and you're going to tell me based on years of experience. Remember, 1 minute of analyst time is worth 17 years of an ordinary mode.
Of course,
So,
gotcha.
2008.
Okay.
Dividend.
Yeah.
0.
Right.
2009.
Yeah.
0.
Yep.
2010.
Yes.
0.
Okay.
2011.
Yeah.
0.
Yes.
Okay, give me your forecast for 2012.
Can I get a lifeline?
I think you want to just do this based on experience.
0.
There you go.
Is that it?
Amazing.
Do I win an iPad?
Well, think about it. Between the two of
That's
us,
what
we have
Stern had on today. He was giving away iPads. Yeah.
32 and 3/4 years of experience between
Right.
the two of us. That's 60.
Is the point they don't have a dividend yield, Mo?
Well,
Or do you think they're about to introduce a dividend yield?
No,
I'm not sure exactly where you're going on
the forecasting. I just think
Yeah.
I think people like an insight. Now, here's another thing.
Yeah.
Here's what I like about this stock.
Yeah.
As a martini drinker,
Which I know you are.
which
Yeah.
yeah, which we were tonight. Look at this. 2009, this stock was up 1,257%.
It seems an adequate return.
In 2000, it was up 256%.
A little disappointing, but I'll take it.
In 2011, down 72. Woo, woo.
Ouch, yeah.
And then in 2012, up 117. Now,
That's just the commodity
Sometimes-
rattling around, isn't it?
sometimes you just buy a stock like this for the sheer thrill of it.
To tell people about it.
When you go
I'm up, I'm down!
when you go to Disney, what do? You don't eat in a food court. You go on the roller coaster.
Rock and roller coaster, that's my favorite.
There you go.
Yeah.
So, I think some of the excitement of owning equities is lost on people. It's a sport, among other things.
Well, this could be one for that.
You own one. Why do you go fishing? The thrill of it. Why do you own a stock like this? It's cheaper than a fish.
You own a gold stock that moves all over the fucking place.
It's $2.54, and it's a thrill.
And it doesn't pay a dividend. Yeah. So you're in it for the thrill.
So,
okay.
Next.
Like all right. Next up, Owens Minor, OMI. Now, the reason we want to do this is because, ladies and gentlemen, this is a real company. They do real stuff. You could actually own this. And I own it, notwithstanding all our caveats. I really do. These guys provide distribution, third-party logistics, just reading the 10K, other supply chain management services to healthcare providers. So they basically provide the products that you might need in a doctor's office to those doctors' offices. And when you think about the percentage of GDP that goes to healthcare, it's ticking up a little bit each year because prices in healthcare go up more than GDP. You know, that is a problem over time. We're going to have to solve it. But, you know, it's not going to be solved by Owens Minor. They're going to just distribute products to doctors' offices. That's what they do. And so it's tremendously stable. In fact, when I look at their sales, they don't have ever a down year. It's always up a little bit. Their EBITDA, looks like during this whole period, including the downturn, EBITDA did not go down. Now, granted, it was up only half of 1% in 2010, but you know that's still up. Their EBITDA margins, this is a distributor, so they're very small. Think of their margins in terms of what a markup would look like to the to the supplier of product. 2.9% EBITDA margins last year, but that's consistently up from 2.3 6 years ago. So it goes up a little bit each year. And then their asset turns 4 times. So again, these logistics companies, they keep margins very low. That means low markups. So the guy giving you the product to distribute is not upset about you overcharging their end clients, but you bring these economies to scale in terms of your ability to get very large, your size. So they're doing low margins but high turnover. That gives you a 6% return on assets. Again, very hard to compete with that because it's low. That keeps competitors out. And then because of the stability, they're able to leverage that a little bit into a return on equity that's consistently in the low teens. And that's perfect because it's really too low to attract excessive competition, and so they keep their business, and it turns into an annuity in that regard. This thing is 7.5 times EBITDA. That's what I love. I take the inverse of that. It's about 14% cash-on-cash return in a market where the long-term treasury is at 1.5. So, again, I love that. Enterprise value to sales, 20 basis points or 0.2. This one gives you a little bit of a dividend yield, 3%, and their payouts, so they're paying only about, looks like about 35% of their earnings out in a dividend. So if they wanted to, they could raise that payout, make the yield a little higher. But I don't think they're going to do that. It's been a pretty consistent dividend payout ratio. So very stable revenues, stable earnings, a little bit of a yield, 14% cash-on-cash return to an outside buyer, and you get a little growth on that, which would be kind of, I'd say, 5%-ish range. So really something you could put away for a long time.
Yeah, and I think the story here is the yield. You know, when I first looked at the stock, I was thinking, down 11% in 2008, up 14, up 2, down 5, up 4. If you look at the chart, it's a pretty flattish stock, and I was
it is.
I was wondering what there is to get excited about it until I realized, it's a cash cow. These guys have had, a 3% yield's nothing to sneeze at, especially in this market, and you might have some dividend increases, which leads us to the next question of the show. Ready for a
got going?
Dividend forecast? You ready?
Absolutely.
We're starting.
I couldn't be more ready.
We're starting in 2007.
Okay.
40.
Yeah.
2008, 50.
Okay. Can I take some notes here? 40, 50, yeah?
2009, 60.
Yeah, 60.
2010, 71.
Yeah.
That would throw you a little bit.
Yeah.
2002, 80. Sorry, 2011,
Yeah.
80.
80, okay.
2012,
Yeah.
90.
Okay. I'm going to go in a range.
Do you want to
I'm going to do a range.
Do you want to stop for a minute and think?
No.
Right.
I'm going to just think on the fly, let people
No
watch
ranges.
the process.
No ranges.
I want to go in a range. No ranges.
You know what Woodrow
Right.
Wilson said? He said, "I wish I had a one-handed economist."
Really? Well, on the other hand, I'd like to just give you a single. I'm going to go with $1. $1. $1.
$90. Yeah.
Is that right?
It looks right to me.
My parents would be so happy
So
because they spent so much on my education.
So
It's great.
So now you got $1 on a $28 stock. You got a pretty nice yield. It's a cash cow. It seems stable, and I agree with you. It's an interesting one to look at.
Well, I can also, one problem with the valuation. So you're right to say the stock's been flat. But here's what I want to say about that. Healthcare stocks, and I think it's largely driven by pharma companies that have a lot of drugs coming off patent. But who can say? But the whole healthcare industry, including great companies, and I'll just say like Medtronic, that has a whole host of fabulous equipment that saves lives across a whole bunch of categories. Their multiples, their PE multiples, 10 years ago were at 40% types of premiums to the average because I think people really felt confident in the growth rates because of the demographics of an aging population and the fact that people, were certainly willing to pay a premium margin for products that could save their lives or improve their quality of life. Well, now, 10 years later, 15, I lose track, but all these healthcare stocks are now at discounts to the market. Why? Well, the pharma companies haven't been inventing new drugs. The price increases that were traditionally coming to the equipment guys have come under scrutiny, so it's harder to predict, them going into the future, blah, blah, blah. But here's what I'd say about all that. Right now, from this level, one of the things you have in these stocks that you did not have 10 years ago is the potential for multiple expansion. So 10 years ago, when you buy a stock at a 50% premium to the market multiple, guess what? It's at a premium to the market multiple. So for the last 10 years, expectations have been just kind of puffing out of this whole sector. You've got the risks of socialism, you got price controls from Medicare, blah, blah, blah. All the premium is out. All the expectations are out. So one of the things you have when you own these things is the likely outcome for the stuff that's unexpected from here is good. I mean, this is one of the secrets of the value investing concept, is that if you buy something when everything's washed out of the expectations, the chances start to be that some random stuff that happens is good versus bad, and the multiple only has one way to go, which is up. So for a company to be so stable as this, now remember, the long bond is at 1.5%, and so that's 70 times earnings. I'm just calling it like it is, that don't grow. These guys are at some lower multiple, 15 times earnings, that do grow, and they pay you twice the yield that the long bond will pay you. So,
and that yield's going to go up again next year to $1.
So that's kind of my thing on that.
Yep.
Okay, last stock of the week. A little stock we like to call U.S. Home Systems, ticker USHS. And let's see. Why? Let's see. Is this your... These guys are, they're 6 times EBITDA. That's a 16% cash-on-cash return. They're putting up a 13% return on assets, 17% return on equity. That's all very interesting. They're trading, at, I just mentioned, a pretty good multiple. And, no analysts are, there's 3 analysts, so it's likely there could be some information here people don't know about. and they're in the home improvement business, which I think in a period where there's not a lot of home transactions going on, people, maybe take an extra little bit to enhance their own home. I don't know.
Well, there were a couple things that struck me when we were going through these, and one was, look at this chart. This thing has been a huge performer. It was up, it was up 86% in 2010, 36% in 2011, 31% in 2012 year to date. And so you look at this thing and, all right, there's clearly a story there because the graph looks great. And then I started thinking, all right, so they do resurfacing of kitchen cabinets. They do, there's a huge overhang of foreclosed homes. And a lot of these homes are pretty damaged when people leave them. And so I think when you think about a big macro trend, is it likely that as all these foreclosed homes finally get absorbed in the next 5 to 7 years in the marketplace, people who are buying them on the cheap. They're getting a great price, but they're buying them on the cheap. They're not necessarily going to come in and put in a $100,000 granite kitchen with all of the stuff like you've got in your house. They're going to come in. They're going to want a resurfacer. They're going to want somebody that does these rehab stuff.
I'm a renter.
It was a pretty fancy barbecue.
Yeah.
Anyway, so there may be a play there. They may be these are the guys that are going to be the big beneficiaries as people buy these foreclosed homes and start fixing them up in a very cost-effective way. So I thought, oh, that's sort of interesting. The margins are only, the EBITDA margin is only 5%, so there's not a lot of give. But they have no long-term debt, and the sales have been going up, 110, 150, 170, 180. Sales have been cranking along.
It's amazing how consistently good this is. And look, 90% of their business is kitchen refacing, which is cabinets, isn't it?
And that's what people do. If we're really in for a period of 4 or 5 years of 2% economic growth, you're not going to have a lot of. People are still going to want to update dated kitchens. Trust me. Talk to
a few bucks in
my
that
wife
area.
is an expert in that, and so I think it's a good long-term conceptual play.
Well, there's 3 analysts, so again, information.
Now there's
is
4?
not, 3.5 if you count us, right? And I think that the kitchen is a place where your return on investment as a seller is very good, and so that makes sense. Their gross margins here are remarkably consistent in the 50s. And when you take their costs into account, they're putting up an EBIT margin of 5%, which is, again, something that's hard to compete with. So it looks like as long as you can, have this overhang or this excess inventory, which at least in our calculations could be quite a few years ahead, you're going to have this outsized business opportunity. And then some point, 2 or 3 years from now, you're going to drip back down, but I would say that even at those lower levels, you've got an annuity of, they did 11 EBITDA last year. Maybe you could count on, 6 to 8 as an ongoing thing. And with them trading at 6 times EBITDA, that lower number would still be 8 times EBITDA, which is 12% cash-on-cash return in a more mature market, so still attractive relative to bonds. So I think it's an interesting name.
Yeah. Yeah, that's interesting.
So that's it for stocks this week. I guess we have some options. I wanted to make an announcement, Mo.
Yes.
Yeah, a couple things. First, the Value Guys Stock Talk show had its highest rating ever in 6 years of the show last week at number 23.
11 listeners.
Yeah.
A new record.
Well, listen, you get over that 10 number, a lot of people come. And so, that was kind of cool. But then a sad thing.
What?
A sad thing. Well, the muse, really, for the show, Car Talk, those guys are retiring. And
we are going to be replacing them, but we're letting you know that before the media knows.
Yeah, no one knows.
They'll know that
knows.
tomorrow.
We're negotiating for it.
Yeah.
But I think, those guys, they had such a great show, and I was listening to it again last week, as I have done for 20, 30 years. You know what they do on their show that we can really do?
What?
Call-ins. People call in.
Yes.
So here's what I want to do. I want to make an announcement. I tried this a while ago, but tonight we're bringing call-ins. I want to really kind of, there's a lot of demand for call-ins. We got a lot of listeners with call-in. So I want to, I got a couple listeners. We're going to have some call-ins. So here we go.
What's the number?
Well, no, we got some people on the air. So, hello, Mr. Smith, you're on the air. All right, well, clearly there's something didn't go right. All right, hold on.
Did we give him the...
Huh?
That's the bat phone on your desk. Don't you need a regular phone?
No, we have a couple listeners. So let me get to another one here. We'll try, we have a listener here.
Nope.
Okay, clearly that's... anyway, okay, we're going to have to work on it. That didn't go as well as I'd hoped. I had a caller there, but
that happens. We need more tech support, but after the show starts generating revenue,
I will say, if anybody wants to call in and leave a question, you can just dial me up and leave a message. You could call. What is my number? I'm gonna think about which number I want to give.
Let people know.
Yeah.
And don't forget to check the website, thevalueguys.com, for the auction on our lunch. Bids have gone from 87 cents
what are we
at the
up to
beginning
now?
of the show, $1.11.
Okay. What are we going to do? This walking through economic trends? Yeah, we have a chance. So I think we just have to pause the show because we haven't done any work on this whatsoever, and we'll just be right back. Okay, we're back, ladies and gentlemen, with walking through national economic trends, or paging through.
And while you were tuned out, we actually were playing some great music.
Yeah, we did. I'm trying to pick an outro. So
music to think by.
Okay, so a couple of important announcements here. One, this is all data coming from the Federal Reserve Bank of St. Louis, and I'd like everyone to completely ignore the fact that the Federal Reserve of Washington made a $500 billion error earlier in the show with regard to cash balances. These guys in St. Louis, rock solid.
Get it right.
They don't make these kinds of mistakes. So we're just paging through. If you go to their site, you'll get all the economic data you need to know. Just paging through, looking for something kind of, to tell the folks.
Well, keep going. When you get to page 7, I got a question for you.
I got something on page. I'm on page 7.
Great.
I'm on page 7.
2 questions.
Yes, sir.
First page, first chart on page 7 is interest rate since 1987.
Yeah.
Now, I mean, you look at this graph and you realize that since 1987, treasuries have never been at zero. Well, until 2000, beginning of 2009.
Yeah.
So all the way back to 1987, interest rates are basically zero. When
That's
it comes
the 3
to
month.
3 month, I know,
yeah.
close to zero. Historically, the lowest rates since at least 87.
Yeah.
Do you ever look at a 50-year chart and say, these are the lowest they've ever been in 50 years? There really isn't a game changer. These are going back up. In the next 5 years, they're going to go right back up to, look at what these rates have been. They've been between 6 and 9%.
They got to go back up.
So
eventually, yeah.
What do you just generally play if you think we haven't seen anything like this maybe in 50 years? It's going to go back up. What do you play?
Well, first thing you do is you don't buy long-term bonds. There's a concept called duration.
Right.
And that's a weighted average of the cash flows, et cetera. I don't want to bore you with that. But basically what it says is when interest rates go up, the principal value of your bond goes down, and it goes down in relationship to the maturity on the bond. So if you have a 30-year bond, the average of that maturity, given that the principal is a big weight at the end, it might be at these interest rates, 15 years or 20 years. That means for every 1% change in interest rates, like from from 1.5 to 2.5, your bond goes down 20%.
Right.
So there's a huge risk. And frankly, I was talking about this with a colleague the other day. I don't know how anyone buys a bond, let alone a treasury. I mean, they buy these for safety, but you're not getting much more than you'd get if you just bought a safe and buried it in your yard. But you get a little bit, I guess. But how about Greek bonds? Paying we had a thing, we're going to privatize Greece. Well, frankly, they're not going for it, so they're selling bonds to try to avoid our plan.
I think I'd rather buy Greek salad.
Well, they're
than Greek bonds.
6.5%. I mean, who reaches for that when the place could go tapioca? So, I think the whole curve, the whole yield curve internationally is messed up, and that's why equities are so attractive. We talked about a couple of stocks today with a 3% yield. And it grows as they grow earnings.
As we did on our dividend guest
dividend. I can't explain
this. Well,
this.
one more question. I said 2 questions on this page. I'm looking at the bottom page. And, I just did this. Tell me if you think I'm crazy. There's a graph down here of the Standard & Poor's 500 index, what its percent change year over year was. And I'm counting 4 periods since 1987 where the return on the market was negative. Period around 87, 88, period around 90, 01 to 03 was kind of bad, and we've had 08 to 09.
Where there was an extended period of negative returns versus last year.
Right.
Yeah.
But that's 8 years out of 87.
Yeah.
We've just had 2 bad periods sort of back to back. But 8 years out of 87, that means that if you invested in the stock market only 7% of the time, you'd be slogging through a bad market.
Yeah, no, I completely agree with that.
So, but
the perceptions of these numbers aren't as bad as the actual numbers, or are worse than the actual numbers.
Absolutely. They just did a survey where they said that 60% of people under 30 years old said they wouldn't trust their money in the stock market.
Yeah.
And, when you look at this with a little bit of a historical perspective, the fact of the matter is, longer term, it has always been good to be in the stock market.
Yeah, it has. I mean, there's a few periods where if you bought at the peak, you're unhappy, and all your friends know it, and all that.
For a while.
Yeah. But the fact, most people, most of the time, this gets back to a very simple strategy of investment that a lot of a lot of bank trust departments recommend, because it's just put $100 a month in the stock market. That way, when stocks are down a lot, you're buying more shares. When they're up a lot, you're buying fewer shares. And I think it's called a dollar averaging over time. And over the entire history of the world, it's worked. But you've had to sometimes wait as long as, 8 to 10 years during, like, the Depression. The 30s was bad, and this is proving to be a difficult
or in some cases, 1 or 200 years, as was the case in the Iron Ages.
Well, in the 100-Year War, that was a problem.
And Paleolithic.
Yeah.
There are some periods in the Paleolithic.
But if you bury your assets, you're fine, and your grandchildren dig it up, and they're fine.
But it's usually more like 8 years.
Yeah, it's more 8. Yeah.
Not 100.
Yeah.
Yep.
It could be 100, though, and no one's predicting that this time. Unless you are, Mo.
No, I'm not.
Okay.
But I have one more quiz for you.
Yes. What page are you on?
I'm on page 9.
You're paging rather rapidly.
All right, I have a question for you. Do the math for me.
Okay. Where's my HP 12C? Wait a minute.
You have it? You can use my
I got it right here.
iPhone.
I
ready?
retrieved it from the Smithsonian. Yeah.
Something starts at 65.
Okay, 65.
And
punching that in.
And it goes to 4.
This has reverse Polish notation.
I know.
Which a lot of people don't know about.
That's true.
Yeah. What was
but even the iPhone has the same
it
reverse
has it now. Yeah.
So something goes from 65 to 4.
Okay, that's a decline.
Of?
Yep. 65 to 4. Let's do the math. That is a 93.9% decline, Mo.
Well, that's what's
happened. What did that?
Natural gas prices.
Oh, yeah. That explains my coal portfolio.
From 2008 to 2012.
Yeah.
natural gas price spot and futures have gone down 94%.
Yeah, well, that's the.
I knew energy was. I knew especially because of the flood of natural gas, fracking. I know the big story.
Yeah,
94%.
yeah, that's big. That is off a peak, a little peaky.
Fair enough.
But yeah, no, it's big time. I mean, chemical companies are now building. Dow is building a factory on the Gulf Coast to take advantage of low gas. It's a huge game changer for America. Absolutely.
Well.
I had that circled as well because what this does is America has now the lowest cost energy of any nation, and so that should help us in terms of longer term thoughts about growth. Cheaper energy means more manufacturing is coming here, and that helps our national wealth. So that's great news. Well, let's see. I had one here, Mo. I had one kicking in on page 11, as I'm just paging through here, and that is unemployment has been going straight down since the second quarter of 2009. Job openings, which is perhaps even more important, because frankly, if my neighbor's unemployed and then he gets a job, that doesn't affect me. What does affect me is job openings. So that line has been going straight up, and I know it's an election year. There's a lot of debate back and forth about what's going on, but I think this trend is very good. The economy is slowly repairing, and job openings are improving very consistently now for almost 3 years, and going up, each period. So I think that's a very positive result. We're now almost 3% growth in the number of job postings, and my guess is this little chart is looking at newspapers and Monster.com and things like that. So I thought that was noteworthy. And then I had...
I have one question for you on that.
Yeah, okay.
Job openings.
Yeah.
One of the things I love about longer term pictures is that job openings, if you look in 2007, on this graph was number 6. And it got worse and worse and worse through 2009. It went down to 2, and now we're up to almost 6 again. Does that mean we plateau? Or if we were looking at 50 years worth of data, do you think job openings would have been higher than that?
We don't have a lot of data. I don't think they get higher than that because it's related to GDP growth and things like that. So 6 may be as good as it gets. I don't know. That's how it strikes me, though.
Okay.
And then, let's see. I had a couple of, on page 13, just want to note, I want to do a shout out to the Consumer Sentiment Index. Hey, Consumer Sentiment Index. Hey, good job. This thing's going straight up since the third quarter of 2011, after a little respite last summer when we were all worried about a double dipper, and now it's going straight up. I suspect that this week it's been going down, but on this chart it's been going up. And then I had one on, I'm going way to the back of the book here, Mo, page 20, and the show's getting long, so we're getting near the end here. Let's see. Output per hour. What I like about this is it's right at about 3%, which you look back over the last 23 years, and it's smack dab in the middle, so there's something going on in terms of productivity improvements. That's a linchpin to GDP growth. That's how come GDP growth per capita can be above population growth, or can be positive at all, I should say. And it's why GDP per capita is faster than population growth. Its output per hour is growing at a pretty consistent rate of 3%. It's up and down here and there, but that's looking pretty good. And it gives me some confidence in predicting that GDP growth is going to be this number, 3%, plus population growth, which is, 1.5 or something? So nominal GDP back to 4% next year, Val Hughes prediction. And then finally, page 20, which let's see, where the heck is it here? I already did that one. 21. Manufacturing output per hour. Again, this is, productivity. It's wealth per capita. It's why America has the highest wealth per capita in the world, with the exception of some small countries like Finland and stuff like that, Switzerland, what have you. Manufacturing output per hour in the most recent quarter up 6% versus last year. Output per hour. It's a lot of productivity. So I want to shout out to all the manufacturing workers out there. Good job. That's really helpful. So
Right below that, shout out to corporate profits. Yippee!
yeah,
Look at that chart.
yeah. I didn't. Yeah, that's pretty amazing. So corporate
gotta-
profits look like they're at a near an all-time high as a percent of income.
If you
total
go back
income.
to 1987, they haven't
Yeah.
been anywhere near this since
Yeah.
1987 ever.
So good job, corporations.
Keep it up.
Keep it up and increase your hiring. That'd be great.
Yay! Yay,
So I
guys.
guess that's about all we have this week on The Value Guys. I want to thank everyone for listening in. This has been The Value Guys Stock Talk Show. We've had a couple of great ideas, and let's name our favorite. We haven't been doing that. I'm sure Phil's been missing that. So we got to... What's your favorite this week, Mo?
I think I'm going to go with the gold.
Going with the gold. I'm going to say...
U.S. Home.
No,
Nope.
OMI, Owens Minor, because of the stability of medical products
And the yield.
supply. I like that a lot. So thanks again. See all our caveats, index to past shows, pictures our moms took, www.thevalueguys.com. So long, everybody.
Good night.